please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Counting down to pre-open should be a bit of a soft start because today Asia is also following suit of what's happened in global markets or US markets overnight. 10,572 on the SGX Nifty, though once again reminding you that it's got it wrong over the last 3 or 4 days. Manisha Gupta now joins us for the commodity cues. Manisha, good morning.
Morning, Anuj, and thank you so much for that. Well, let's start with the crude oil prices, where we did see a 3.5-year highs of 75.47 yesterday. But from those kind of levels, we have seen a considerable profit taking, trading below 74 on your screens right now. And this is after US and France have talked about perhaps preserving the US and Iran nuclear deal. I mean, US still has until May 12th to finalize it. But with the kind of statements that we have seen come out of that meeting has taken the premium off the prices, and some profit taking was in the coming because you have seen prices gain up quite strongly, still up 20% from Feb lows, but we have seen some decline in the last 24 hours. And it's a 5th straight day of aluminum prices declining as well. We are now 13% off the 7-year highs that aluminum prices hit in the previous week itself. Some reprieve, some ease that is coming in on the way to resolve from US has led to profit taking here as well. And that really seems to have let down on other metals, where you have seen the iron ore prices decline. Nickel is also trading on the weaker side. A couple of metals which are actually doing good is copper, where Chinese imports have seen a strength coming in. And also you have seen the copper inventories on the LME decline. The other metal that is doing well today is the steel prices. You are looking at 1.5-month highs on that. Decline in inventories and strength in demand has been supportive for that.
Okay. Thank you very much, Manisha. We'll look forward to how these cues play out on the equity market as well. At the moment, I mean, Bharti started off an idea at 10% higher. I doubt that. It's already cooled off a goodish bit.
Negative start, actually.
Yeah, it was 66.40 even in the curb trades.
Yes,
so it is negative.
Yes.
But yesterday's rally also was a little unnatural. 66.40, we have been there, done that. We have gone up to 66.48. If it crosses 50, it will be a little bit of a fresh 13-year low. Until then, we have been there and done that. But yes, it's certainly starting lower. And now the markets have cooled off and gone a little bit into the red. The Sensex at least has. The Nifty is still in the green and a good 0.5% in the green. But I don't know, why should Axis be 4% higher? I mean, things have not settled down for sure. I think we'll just have to wait it out. I can't see too much even by if idea is 9%. I mean, why would it do that? We'll just have to wait.
Yes, we'll have to wait. A couple of stocks, perhaps. Raymond reported very good set of numbers, so that one in pre-opening is up about 10% or so. Now you have Bharti Infratel post that merger, which the street I guess likes. Bharti Infratel up about 4%. But as the market volatility continues, Aberdeen continues to remain overweight on India. They are currently betting big on names like HDFC, TCS, and the consumption space. Hugh Young, the managing director of Aberdeen Asset Management, joins us on the phone line with more on their India strategy. Hugh, good morning, and thank you as always for joining us. First, tell us what you've made of the recent move that we've seen. So far this year, most markets have been either flat or slightly in the green, India included. But what do you see as the move for the rest of the year?
Well, as ever, it's hard to predict what moves are going to be for the next 8 or 9 months. Our general view on markets globally is, of course, that we will see further interest rate hikes. That typically is a negative for equity markets. And one of our perennial issues, I guess, looking at India has been the valuations of India, because we look at a whole range of global markets. And although India has some really fantastic companies, certainly on the valuation front, India hasn't been cheap for many years. And in previous years, earnings growth has always been slightly delayed. So it's been priced on the expectations of strong earnings growth. And we're seeing some evidence, which is good from our point of view, of that earnings growth coming through, which is, of course, needed to justify the valuations of things like the HDFCs and the HDFC Bank of this world. I mean, luckily they haven't had issues too much with earnings historically, but other sectors have been challenged on the earnings front.
Okay, Hugh, hi, good morning. one thing about your portfolio, you endured some pain for this, of course, is that you have been very overweight on IT. Stocks like TCS, Infosys. It must be very pleasing for you to see the kind of big move that we have seen in TCS and even Infosys for that matter. You reckon the Indian IT can be the leading sector from here on?
I think it's, I mean, in a sense, its stunning heyday is over, so it's now a mature industry, which is obviously having to meet challenging changes in the businesses it serves, so it's having to upgrade itself, which it's doing with a variety of success, and we've seen some full starts maybe at the Emphasis, thinking of Emphasis in particular. TCS seems to have adapted a little better, although frankly both companies do operate pretty rapidly in the face of changing circumstances. So the industry is certainly not over, but it's quite a mature industry with some global challenges coming through, and that's reflected obviously in the ratings that it now stands on. So the ratings have come down quite substantially from the high levels of yesteryear.
Yeah. Fair point. Will, Hugh, good morning. But can I drag you away from micros to a bit on the macros? We were told to expect apocalypse when the 10-year touches 3% in the US.
Yes.
It's happened. Life is still normal. But should we start worrying that as money gets expensive, an EM investor should worry?
Yes, in a very broad sense, yes, but it's good that we're all worrying. In a sense, the things that we discuss and worry about when they actually happen maybe have less effect because we have been discussing them and highlighting them as a risk. So goodness, we've been talking about rising interest rates for the last 5 or 6 years, and of course they haven't, and now eventually they are.
Yep.
And I think that ultimately that's very healthy because some of the distortions in markets have been caused by interest rates being artificially low. At least in India itself hasn't joined in that particular phenomenon.
Okay. The other space I wanted to talk to you about, and something that has done very well for you, is the consumption space, Hugh. Stocks like ITC, HUL, Godrej Consumers, etc. At what stage of the upcycle do you think we're in the FMCG space? Is it still nascent, or have we reached some sort of mature space where there's not too much upside left?
Well, again, the issue for us in that space is valuation, and whether we're seeing the earnings growth coming through, and of course each company is a bit different, but certainly there is still substantial upside overall when you look at India itself. But there needs to be that upside in terms of earnings to justify the valuations that the consumer stocks are standing on currently, which are pretty high.
Okay.
So when you say pretty high, would you sort of refrain from putting, fresh money to work in some of these spaces, including IT and FMCG?
Overall, we haven't really been adding to either. As you know, our style is very much as long-term investors in India. Many of these companies we've held for 10 or more years. And yes, they get expensive from time to time, but our focus is on whether the underlying businesses are being well run and doing all the right things, because ultimately, when that growth comes through, it'll make today's valuations, and this is what we hope, look, although they look expensive today, in 5 years' time, we'll think what a good thing it was that we held those stocks.
Okay. Well, just for your information, at the moment, the dollar is the most expensive it has been since September 2017 in rupee terms, 66.56. Last seen on, I think, 3rd September or 7th September, but a pretty long time ago. That's the dollar rupee. It's gotten expensive. Now, Hugh, you spoke about IT being no longer in that stunning growth phase that it was earlier. If you have to survey India now, what would qualify for that adjective? Which sector?
Oh, yes. I mean, if you look at, I guess the finance sector, certainly the private banks have been in that stunning growth phase, and I think there's still quite a bit of growth to go for, there. But of course, as a country develops, as India has, by definition, the growth across all sectors matures to an extent. And I think you're seeing that visibly happen in many. Of course, there'll be a lot of the new startups and internet-related companies and the like that we don't even know about today that will turn out to be the stunning TCS equivalents.
Okay. Yeah. No, I heard you said private banks, but it is the non-banks, the non-bank finance companies that have shown extraordinary growth, and not just the plain lenders, but also the insurance, the wealth managers. You like anything specific in this subcategories?
Well, again, there's quite a bit to go for there, and we have holdings in the likes of GRU, and as you know, as a corporate, we've been joint shareholders of HDFC Life and HDFC Asset Management, which have been phenomenal success stories with still more to go for.
Oh. Sure. Okay, before we let you go then, just to summarize what you've said so far, is it fair to assume that despite you being overweight on both India and China, you prefer China over India because of valuation concerns?
I think on pure valuation, yes, China you can argue is cheaper than India. I think on quality of corporates and comfort with the corporates, although China is improving by the day, I think in India still is where we have higher comfort, and we've got relative to benchmarks. We've got a far higher overweight to India than we do to China.
Okay. All right, Hugh, thanks a lot for your time today, this morning. That's the view from Aberdeen. The pre-open...
Just a correction, rupee now at a 14-month high.
Okay.
So February 23rd was when it was over 66.
Okay.
56.
Also, today is the contract expiry on the futures for April. So at 12 o'clock that happens, that you move to the May futures. But the pre-open has settled nowhere near what the SGX Nifty indicated once again, 10,612. On the Nifty down only 2 points, and the Bank Nifty down about 50 points. Ashwini, your thoughts? Is it actually presenting a trade here, and your 9-10 call?
It's telling you that there is no follow-through. So I don't think the index has a great amount of trades that can be executed. I think I would still go with the 914 India Bulls Ventures. That's a buy with a stop of 424, target of 450.
To do on Bharti Airtel now, Ashwini, I mean, the stock is one of the big gainers today, but considering that it's eroded so much wealth over the last 1 year, would you use an opportunity to sell into it?
See, it reached the lower end of its band at 375. So just this piece of news could take it back to 440, 445. So that way, it's gapping up, and chances are you could have a good day on Bharti Airtel.
Oh, yes. In fact, all the three telecom stocks, Bharti Infratel and Airtel and Idea, are the ones that are still lording it over. Of course, these are pre-opening rates. And I just wanted to see how is ICICI Pru doing, whether after all the positives and thumbs-ups that they have got from the various brokerages, there is still more to go. After a strong rally yesterday, it's still up 2%. So let's quickly hear out what Sandeep Batra, the Executive Director of ICICI Pru Life, had to say before the market starts.
During the year, I think we have delivered a robust all-round performance. Our total APE grew about 17%. Within that, the protection APE grew by about 70-odd%. The highlight of the year has been our value of new business grew to by 93%, and if I see a 3-year CAGR number, it is about 68%. Now, you have to see in the context of what we have done for our consumers. If you see our persistency numbers, it is closer to 87%, and the way we calculate persistency, we have not put single premium in its base, neither have we got group in its base. So we believe it's clearly one of the best in class, and is a very strong indicator of the quality of the business that we have written. Similarly, our cost to TWRP on the savings side, where we measure efficiencies, has reduced from about 13.3% to 11.8%. We believe on a long-term basis, India offers great opportunity on the savings side as well as protection. Savings largely on the back of financialization of savings, and protection because of under-penetration. We do believe that the savings business over a longer term will grow ahead of the nominal GDP, and we will grow marginally ahead of that. And that's the view we have been saying consistently, and we maintain with that. We are as excited about this business today as we were a couple of years back. From a shareholder perspective, we are focused on increasing the value of new business. As I mentioned, we had increased it significantly during the course of the year, and this will be a function of product mix and growth. Protection this year was about 4.46 billion compared to about 2.6 billion in FY17, so it has grown by about 70-odd%. So I think the focus will remain on protection. Focus will also remain on savings. The opportunities are different. We are equally committed to the savings business as well as the protection business. So as you did point out, protection has a little more higher margin than the savings business. If protection grows at a faster rate than savings, obviously the margin will improve.